Hey everyone, welcome back to Corporate Dakota, the place where we peel back the layers of corporate filings and find the hidden stories within. Remember to subscribe and hit that notification bell so you never miss an insight. Also, we have a fantastic Discord community linked in the description where we dive even deeper into these reports, so join us there. Today we're looking at Coca-Cola Consolidated incorporated its latest report, and it seems like they've been busy securing some serious funding. They've taken out a massive loan to give us a snapshot of their financial maneuvers. This report from Coca-Cola Consolidated Incorporated details a significant financial move, a new term loan agreement signed on December 8th, 2025. Think of it as a really big borrowing agreement that gives the company access to substantial funds. So what exactly did they agree to? Well, they've secured what is called a senior unsecured term loan facility. That sounds complicated, but it basically means they got a loan that is not backed by any specific company assets, and it is being managed by Wells Fargo Bank. This facility is split into two parts. First, there is a 3-year term loan facility for up to $900 million, which matures in December 2028. Then there is a 5-year term loan facility for up to $450 million maturing in December 2030. All in all, they can borrow up to $1.35 billion. And guess what? They went ahead and borrowed the entire $1.35 billion right away. This is a huge sum of money, and it is clear they needed it for some pretty important things. So why did they borrow all this money? Primarily to pay off another big loan, a $1.2 billion bridge loan. They apparently took out just a month before. That is like using a credit card to pay off another credit card, but on a massive scale. Besides refinancing that older debt, the rest of the money is for general company needs. This includes buying back their own stock, which can boost share prices, giving back money to shareholders through dividends and funding their day-to-day operations and future growth projects like capital expenditures. It shows they are actively managing their existing debt and have plans for growth and shareholder returns. Now let's talk about the cost of all this borrowing. The interest rates on these loans are tied to market rates. They have a choice between two interest rate benchmarks termed SOFR, or the base rate. Term SOFR is based on the secured overnight financing rate, a key benchmark for short-term borrowing, and the base rate is essentially a prime lending rate set by Wells Fargo or other similar benchmarks. The specific rate they pay depends on their creditworthiness as determined by their debt rating. For the 3-year loan, the interest on term SOFR could be between 0.750% and 1.250% per year, with the base rate being even lower. For the longer 5-year loan, the term SOFR rates are slightly higher, ranging from 0.875% to 1.500%, and the base rate remains low. These are pretty competitive rates, especially for unsecured debt. It means the company is seen as a relatively safe bet by lenders. A cool feature is they can pay back parts of the loan early without any penalty, which gives them flexibility. Of course, with such a large loan come rules and restrictions. The agreement includes standard clauses that limit what the company can do without consulting the lenders. For instance, it restricts their ability to take on too much new debt, sell off major parts of the company, or enter into big mergers. Most importantly, they have to maintain two key financial ratios. One is the consolidated cash flow to fixed charges ratio, which basically means they need to prove they're generating enough cash to cover their interest payments and other fixed expenses. The other is the consolidated funded indebtedness to cash flow ratio, which limits how much debt they can have relative to the cash they generate. Specifically, they need to keep their operating cash flow at least 1.5 times their fixed charges and their total debt no more than 6 times their operating cash flow. These are common metrics to ensure the company is financially stable and can manage its debt obligations. The agreement also lays out what happens if things go really wrong. They call these events of default. This includes not paying back the loan, lying in their financial statements, breaking any of the rules we just talked about, or failing to pay other debts exceeding $150 million. Other serious issues like bankruptcy, or if someone takes control of the company without the lender's approval, are also triggering events. If any of these happen, the lenders can demand all the money back immediately. This is standard loan agreement stuff to protect the lenders. And just a heads up, the banks that helped arrange this loan, Wells Fargo, and others might also be providing other services to Coca-Cola Consolidated Incorporated and its affiliates, and will likely get paid for that too. That is pretty typical in the world of corporate finance. So to wrap this up, the main point of this filing is the massive new loan agreement that Coca-Cola Consolidated Incorporated has entered into. They've borrowed $1.35 billion to refinance existing debt and fund future operations and growth. The terms seem reasonable, and the company appears stable enough to secure this kind of financing. Now for my take, this move signals a company that is actively managing its debt structure and is confident about its future prospects. Refinancing a bridge loan with a more structured long-term facility is often a sign of financial maturity and a desire for stability. The inclusion of funds for stock repurchases, dividends, and capital expenditures suggests management believes they can generate enough cash flow not only to service this new debt but also to reward shareholders and invest in the business. The financial covenants are standard, and for a company of this size and reputation, maintaining them should not be an issue. The main risk really lies in any unforeseen economic downturns or shifts in consumer demand that could impact their cash flow, making it harder to meet those debt obligations. However, given their business Coca-Cola Consolidated Incorporated is generally in a relatively stable industry. Overall, this looks like a prudent financial maneuver by Coca-Cola Consolidated Incorporated, demonstrating proactive debt management and a clear strategy for using borrowed funds. It is a big loan, but it seems well justified by their stated intentions. Alright, that is our breakdown of Coca-Cola Consolidated Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.